In today's video, you'll see an interview I did with Alyssa Sica where I discuss why financial gurus like Dave Ramsey and Suze Orman have such an intense hatred for permanent life insurance.
We live in such a day and age now where information is at our fingertips all the time. I remember when I picked up your book for the first time about 5 years ago when I first got started in this industry, and it was a big eye-opener for me. But as technology advances and information is coming in so fast, there's no opposing opinions when it comes to finances and what to do with your money. How would you recommend people should filter all of the things that they're hearing about where you should put your money, what you should do with it from their peers, what they read online? How should people be filtering through this information?
Well, just like they filter through everything in life, I would take a look at both sides of the issues. I would weigh the facts and then sort of draw your conclusions accordingly. And I'll give you a good example. There's a so-called guru out there called the white coat investor. He deals primarily with high income investors like doctors and dentists. And he got a hold of my book, The Power of Zero, back in, it had just come out. So back in like 2015 or something like that. And he basically said, Dave McKnight is crazy for recommending Roth conversions. Tax rates aren't going up. I mean, this is an exercise in idiocy and futility. Why is he doing this? And he just gave his original title for his article was, before I had my attorney send him a letter to take it down, was the David McKnight scam. Well, that obviously is very inflammatory. And so I was interested, what about what I was saying was a scam? And so I actually engaged with him on his blog. And he basically said, tax rates aren't going up and it's irresponsible for you to tell people that they are. They should not preemptively pay tax on their IRA to get that money shifted to tax-free. So I feel like I really, over the course of that blog exchange, I really laid out all the facts for him, but he really wouldn't budge. Well, lo and behold, we're in the lead up to the last presidential election, and Joe Biden comes out with his tax proposal. And he basically, the tax proposal was raising taxes on a lot of different things. And so he's tweeting on Twitter, right? And he says, Joe Biden's tax proposal reads like an all-out war on the individual investor. If Joe Biden gets elected, I am going to convert my IRA to a Roth IRA all in 1 year. So here's a guy who called me a scam artist for telling people that they should do a Roth conversion, who in the lead up to the presidential election says that he's going to convert his IRA to a Roth IRA all in 1 year. I mean, that's not even advice I would give. I mean, you got to spread the tax liability out over a lot of years, not do it all in 1 year. So, I mean, I don't think he was even giving good advice to himself. So the point I'm trying to make here is that there's two sides to every issue. And I think you just have to study out both sides. And instead of saying, okay, Dave Ramsey is right on, for example, permanent life insurance, I think you should read both sides of the issue. And that's really what I've tried to do with my YouTube channel. Is I've gone through and debunked a lot of stuff that Suze Orman has said, Dave Ramsey, the white coat investor. And the goal is just to tell the other side of the story. So I would just tell people, take a look at both sides of the issues.
Yeah. And you bring up a great point. Life insurance is definitely one of those things that is a very hot topic, especially when it comes to where is it that you put your money. Why do you think there is so much controversy around this topic, specifically when it comes to leveraging it inside of your retirement portfolio?
Well, it primarily comes down to this. Dave Ramsey and white coat investor Suze Orman. I mean, Suze Orman has said things like, if somebody brings up life insurance as an investment, you should never talk to that person ever again. I mean, those are pretty strong words from someone who holds herself out as a financial guru. And so it's a really fraught discussion, and people have very strong feelings about it. But again, it comes down to telling both sides of the story. They tend to not like life insurance because for two reasons, really. They say that it doesn't stand up well when compared to stock market over time. And the second one is the expenses are too high. Well, Alyssa, I've been studying this for years, and I've studied the expenses inside of the life insurance, and they compare quite favorably with 401ks. They're a little bit higher in the early years. They're much lower in the later years, but when you average it out over the life of the program, it's going to cost you ultimately about 1% of your bucket per year over the life of the program. And so What Dave Ramsey and Suze Orman do is they look at the expenses in the first year and they say, oh, wow, the expenses are 20% of whatever you contributed, or 25% or 30%. But what they're not doing is they're not looking at the expenses averaged out over the life of the program, which if they did, they would see that they compare quite favorably with 401ks. In fact, they're can be even less expensive than 401ks. And so that's one of the reasons they're not sort of laying out the case in an accurate way, I think, for the expenses. And then the other one is they say that we're trying to utilize life insurance as a replacement for the stock market. And I don't personally advocate that. I'm happy if people want to contribute to put money into their Roth 401ks or whatever, but generally, you know, the LIRP or the IUL, I know that's something that you talk about a lot. I talk about the IUL a lot. The IUL is a great bond alternative. I mean, if you can get 5 to 7% over time without taking any more risk than what you're accustomed to taking in your savings account, that's a pretty safe and productive way to grow at least a portion of your money. Now, if you think you can get 8 to 10% in your portfolio, great. Don't replace the stock portion of your portfolio with IUL. Replace the bond portion of your portfolio. Tom Hegna says it really well. He says, if you reach into your portfolio, you take out the bonds, you replace it with permanent life insurance, you will increase your rate of return, you'll lower your risk, you'll lower your standard deviation, and you'll have a better outcome over time. And so it's just how we frame the debate, and people look at this stuff through a lens of their own making, and they come to their own conclusions based on their own biases. And so that's, we gotta deal with it. We got to figure out a way to engage them in an intellectual way that's convincing to our clients.
Yeah. And you bring up a lot in Look Before You LIRP, the book that you wrote specifically on that, on the importance of finding the right IUL, right? Finding the right LIRP for you. And so how should people go about asking the right questions in appointments when they're sitting down with agents and trying to figure out if this is the right type of agent to be able to set this up for them?
Well, there's a couple step process. The first step they should probably take is they should probably read my book, Look Before You LIRP. I mean, that basically I make the case in Look Before You LIRP that, you know, starting one of these life insurance policies is a bit like getting married. It only really works if you keep it until death do you part. And so I think that's a pretty apt analogy. These life insurance policies can turn into big tax bombs if you don't keep them, if you don't have at least $1 in your cash value when you die. And so I make the case that unless you're planning on keeping this thing literally until you die, then you shouldn't ever begin it. And if that's the case, you should think of it a little bit like getting married. I mean, we all have laundry lists of things we're looking for in a spouse. I know that I did when I was looking for a spouse. And whether we admit it or not, we have a laundry list of qualities we're looking for. And you should have a laundry list of qualities you're looking for in your LIRP or your IUL. And I will tell you that not all IULs are created equal. And there can be some really big surprises, whether it be a loan provision or expenses, or whether they have a chronic illness rider. I mean, I outlined 7 or 8 in my book, Look Before You LIRP. There's really actually about 25 things you should really be looking for. Do you have daily or weekly or monthly sweeps? These are all things that I go over in Look Before You LIRP, because the idea is that just like you look before you leap when you get married, because it's a lifelong commitment, you should be look before you LIRP, because LIRPs are likewise a long-term commitment.
Yeah. And one of the biggest things that you outline in probably every single one of your books, starting with The Power of Zero, is about the tax rates. And so I'll ask you this: when you go and you speak about the future of marginal tax rates and where we're kind of headed, what are the reactions that you normally get from people, and what's kind of going to be the consequences that come along with them, right? Of people believing that tax rates are going to go up or they're not.
Well, you know, sort of like with the white coat investor, I used to have a lot of people that sort of would put up a fight over my contention that tax rates are going up, but I hardly see those anymore. I mean, so many of the experts out there are coming over into my camp. I mean, if you just look at the movie that we filmed in 2018, Power of Zero, The Tax Train is Coming. I mean, we literally crisscross the country interviewing the most important experts in the nation on the national debt as it relates to the future of tax rates. And they all agree that tax rates have to rise dramatically. A couple of them even said tax rates have to double to keep our country solvent. David Walker, former Comptroller General of the federal government, said it in his book, Come Back America. Tax rates have to double by 2030 or we go broke as a country. There's another very important economist by the name of Brian Boileau who says that tax rates have to rise dramatically. He says that we're on pace by 2030 to have a Great Depression because of all of the unfunded obligations for Social Security, Medicare, Medicaid, the aging population. And so I would say very few people actually contest this because we have the math on our side. What are the consequences for people who believe it? Well, it depends on whether they do something about it or not. If they preemptively get their tax deferred assets repositioned to tax-free, then they will have protected their assets from the impact of rising taxes by the time 2030 rolls around. If people don't believe me and all of the other experts that tax rates are going to go up, then the best analogy I can give you is your 401k sitting on the train tracks, a massive freight train is bearing down on it, and it's going to be completely obliterated by that tax freight train. So I think that I've put enough content and warnings out there, be it through my movie or my books, that tax rates are going up, and I try to call upon as many third-party experts as I can, so people don't just take my word for it. But we've put the warning out there, and hopefully people will start to heed it.
Yeah. So as people are kind of approaching retirement, right? Those people that are looking to retire here in the next few years, maybe even next year, what would your advice be to them based off of the state of the market currently and what's currently happening as far as this freight train of taxes that's coming? What would you recommend to those people to start repositioning their funds?
So this is something that I address. I address in my most recent book through Penguin Random House, Tax-Free Income for Life. Basically, there's two things that people need to worry about. One is tax rate risk. We've talked about that so far during this Facebook Live event. But the other one is longevity risk. And longevity risk is the risk that you will outlive your money. Believe it or not, I'd like to think that Americans, the number one risk that they feel like they're facing in retirement is tax rate risk. It's actually not. That's like number two. The number one risk is people feel like they're going to outlive their money. They don't want their money to last longer than they don't want to die broke. They basically want their money to last as long as they do. And so how do you do that? Historically, there's a guy named William Bengen. He was a financial advisor. He says, hey, look, if you only ever take out 4% of your money, there's an 85% likelihood that you'll never run out of money. And that's the 4% rule. Well, a lot of experts are now chiming in and saying that he came up with that 4% rule that the industry embraced for a long, long time. And he did it using sort of outdated data, in that it was based on bond rates that were much higher in a stock market that had a much rosier picture. They're now saying that the sustainable rate of distribution is now only 3%, which means if you have $1 million, the most you can take out in any given year is $30,000 per year and have a reasonably high expectation to never run out of money. Well, guess what? You can get $30,000 per year guaranteed until the day you die through an annuity for about half that amount, for about $500,000. So you can actually mitigate longevity risk much more effectively and much less expensively through an annuity with a guarantee from an insurance company than you can do through the 3% or the 4% rule. And the other thing I talk about in my book, Tax-Free Income for Life, is it's not enough to get this guarantee of income for the rest of your life, because the pre-tax amount of that guarantee is guaranteed, but the after-tax amount is not. So you might have $2,000 per month that's coming in guaranteed, but if tax rates go up to 50%, now you only get to keep half that amount, which might be only $1,000 per month. And how are you going to plug that hole in your guaranteed income? You're going to have to probably spend down all your other assets to compensate. And so really, I would say utilize annuities to guarantee that at the very least your lifestyle expenses are paid for, but do it within an annuity that has what I call a piecemeal internal Roth conversion, which allows you to systematically reposition the annuity to tax-free, so that by the time tax rates go up for good, you've done all the heavy lifting, then you can take that guaranteed lifetime income out of your annuity in a completely tax-free way.
And on the other side of the scale, what would your advice be to the younger generation, people that are just getting into the workforce, trying to figure out this whole retirement thing, saving for the future? What would your advice be to them?
Yeah, that one's pretty easy because as a general rule, the younger you are, the more likely that your tax rate is going to be through the roof in retirement. If you take a look at the national debt over time, it seems bad now, but by 2030, it's going to be, 40 trillion dollars of debt. By 2050, it might be $50 trillion of debt. So the federal government doesn't have any plan for how to reduce or even pay off the debt. And so that's bad news for people who plan on retiring 10, 20, 30 years from now. So I guess the best advice I can give people who are younger is take advantage of all of the tax-free savings tools that the IRS affords you. Take advantage of every nook and cranny in the IRS tax code. Take advantage of IRAs, Roth 401ks, permanent life insurance. Take money out of your IRA up to your standard deduction. So that's also tax-free. And if you can keep your provisional income low enough, then your Social Security is going to be tax-free as well. Take advantage of everything that the IRS has to offer you. And if you have kids, if you have a family, then the great part is the LIRP, the IUL has a death benefit component. If you keep it your entire life, when you approach the end of your life, you'll have a death benefit that doubles as long-term care as well. I think that's absolutely huge. So there's a lot of living benefits that are associated with life insurance that people don't think about. But remember, life insurance is a part of the puzzle. It's used in concert with all of the other tax-free vehicles that are available to you.
Awesome. Well, thank you so much, Mr. McKnight, for being here with me. I know you brought so much value. I hope that everybody watching really takes your advice and does something with it, because we always say it's not knowledge that's power, it's applied knowledge that's power. So thank you so much for being here, Mr. McKnight, and thank you so much to everybody who logged in to watch.
Hey folks, thanks for listening. If you have any comments or questions, feel free to drop them into the comment section below. I respond to all of them personally. If you need any help tailoring a strategy that helps insulate your hard-earned retirement savings from the impact of higher taxes, head on over to davemcknight.com and click on the Work with David button. I'm happy to lend a hand. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.